artificial intelligence. These two words have completely taken over the world in the last few years. From writing emails to creating stunning art, AI seems to be everywhere, promising a future straight out of science fiction. Companies at the forefront of this revolution, like Nvidia, OpenAI, and Google, are seeing their valuations soar into the trillions. It feels like we're on the cusp of something massive, a genuine technological leap that will reshape our society. But hold on a second. Does any of this feel familiar? Sky-high valuations, frenzied investment, and promises of a new world order. We've been here before. Remember the late 90s? The dot-com bubble. Back then, any company with a com in its name was an instant Wall Street darling, regardless of whether it had a viable business plan or, actual profits. The hype was infectious, and everyone wanted a piece of the action. Until they didn't. The bubble burst, fortunes were lost, and a lot of promising sounding companies vanished overnight. So the billion-dollar question, or maybe I should say trillion-dollar question, is this. Is the AI boom we're seeing today another dot-com bubble waiting to pop? Or is this time really different? Let's look at the parallels first, because they are pretty striking. The sheer speed and scale of investment are staggering. Governments and venture capitalists are pouring billions upon billions into AI, creating an intense race to the top. This frenzy is driving valuations to levels that are hard to justify with current revenues. Just like back in the dot-com era, there's a fear of missing out, or FOMO, that's pushing investors to jump in, sometimes without fully understanding the technology or the business models they're backing. We're hearing the same revolutionary language, the same promises that this technology will change everything. And just like then, major financial institutions like the Bank of England and the OECD are starting to sound the alarm, warning that we might be inflating a dangerous bubble. But here's where things get more complicated, because there are also some fundamental differences between now and then. The biggest one, utility. Back in the dot-com era, many companies were built on pure speculation. They had a website, an idea, but very little real-world application or revenue. Today's AI giants are different. Nvidia isn't just selling a dream, they're selling the actual chips, the hardware that powers the entire AI ecosystem. And they are selling a lot of them with profits to match. Companies like Microsoft and Google aren't just experimenting with AI, they're integrating it into products that billions of people and businesses use every single day. We're already seeing tangible productivity gains from AI in software development, customer service, and content creation. This isn't just a hypothetical future, it's happening right now. Think about the infrastructure. The internet in the late 90s was still in its infancy. Dial-up was slow, and the digital plumbing needed to support a truly online economy just wasn't there. Today, we have high-speed internet, cloud computing, and a global digital infrastructure that's ready-made for an AI revolution. The very foundation is stronger and more mature. Another key difference is the players involved. The current AI boom is being led by some of the largest and most profitable companies in the world. Apple, Microsoft, Google, Meta, Amazon. These aren't fragile startups running on venture capital fumes. They have deep pockets, massive user bases, and established business models. They can afford to invest heavily in research and development for the long haul, weathering market downturns in a way that most dot-com startups simply couldn't. This concentration of power in the hands of a few tech titans is a whole other conversation. But in the context of a bubble, it does provide a certain level of stability. So, where does that leave us? Are we in a bubble or not? The truth is, probably somewhere in the middle. It's not a simple yes or no. It's more likely that we're experiencing what we could call a frothy market. Yes, some AI companies are almost certainly overvalued. There's a lot of hype. And when the dust settles, many of the smaller, less focused AI startups will likely fail or be acquired, just like their dot-com predecessors. There will be a correction. There always is. But to call the entire AI movement a bubble on the scale of the dot-com crash seems to miss the point. Unlike the vaporware of the 90s, the core technology of today's AI is real, powerful, and already creating value. The AI revolution is not a fad. The fundamental shift is happening. The real question isn't if AI will change the world, but how and when. The dot-com bubble, for all its destructive chaos, did pave the way for the internet age we live in now. The companies that survived, like Amazon and Google, went on to define the 21st century. Similarly, the current AI frenzy will likely have its casualties. Investments will be lost and valuations will come back down to earth. But the technology itself is here to stay. The companies that successfully navigate this period, the ones that build truly useful and profitable AI applications, will likely become the titans of the next generation. Right now, AI is the engine of technological growth, but history has shown us that what goes up can sometimes come down, and often with a big bang. Let's dive into what a bursting AI bubble could mean for all of us. The first and most immediate impact would be on the financial markets. Think about it. So many of us, whether we realize it or not, have a stake in the success of these big tech companies. Your pension fund, your 401k, the ETFs in your investment portfolio, they are all heavily invested in AI-related stocks. Companies like Nvidia, Microsoft and Google have seen their valuations skyrocket. If the bubble were to pop, these stocks would plummet. We're not just talking about a few percentage points. We could see a massive sell-off, wiping out trillions of dollars in market value almost overnight. This wouldn't just affect the wealthy, it would hit everyday people hard. Your retirement savings could shrink dramatically. The value of your investments could fall off a cliff. This initial shock would send ripples through the entire global financial system. Beyond the stock market, the venture capital world would freeze. Right now there's a gold rush mentality. Investors are pouring billions into any startup with AI in its name, hoping to find the next big thing. But when the bubble bursts, that money disappears. The flood of cash turns into a trickle, and then it dries up completely. Startups that rely on this continuous funding to survive would be in deep trouble. Imagine thousands of innovative companies, many with genuinely brilliant ideas, suddenly unable to pay their employees or keep the lights on. They would be forced to lay off staff or shut down entirely. We'd see a wave of bankruptcies across the tech sector, especially among those companies that were highly leveraged, meaning they borrowed heavily to fuel their growth. This brings us to the job market. The tech industry has been a major source of high-paying jobs for years. A collapsing AI sector would lead to mass layoffs, not just at startups, but also at the big tech giants that would be forced to cut costs. Engineers, data scientists, project managers, and countless other professionals would find themselves out of work. This sudden spike in unemployment in a high-wage sector would have a cascading effect on the broader economy. When people lose their jobs or fear losing them, they stop spending money on non-essentials. This drop in consumer spending is a huge problem because it represents about 2/3 of the economy. People would cut back on new cars, vacations, home renovations, and eating out. This reduced demand would hit other industries hard, from retail and hospitality to manufacturing and real estate. Businesses in your local community would feel the pinch as their sales decline. As consumer confidence plummets, a sense of economic pessimism would take hold. This is where the psychological aspect of a recession kicks in. Fear and uncertainty would spread. People would start saving more and spending less, creating a vicious cycle. Businesses, seeing falling demand, would cut back on their own investments and hiring plans, further slowing down the economy. Let's look at the global picture. The United States is the epicenter of the current AI boom, but its effects are felt worldwide. A downturn in the US tech sector would have severe international consequences. Many countries are deeply integrated into the global tech supply chain. Think about the companies in Taiwan, South Korea, and the Netherlands that manufacture the advanced semiconductors and equipment needed for AI. A sudden drop in demand from the US would devastate their economies. Global trade would slow down. Investment flows between countries would shrink. Emerging markets that were betting on tech to drive their growth would be particularly vulnerable. The entire global economy which has become so reliant on this single engine of tech-driven growth, would find itself sputtering and stalling. So what would the recovery look like? It wouldn't be quick or easy. After the dot-com bubble burst in 2000, it took years for the tech industry and the wider economy to recover. A bursting AI bubble could be even more severe because AI is more deeply integrated into every sector of the economy than the internet was back then. The recovery process would be painful. We'd likely see a period of economic stagnation with slow growth and high unemployment. Governments and central banks would have to intervene with stimulus packages and interest rate cuts to try and restart the economic engine. But rebuilding investor and consumer confidence would take time. However, it's not all doom and gloom. It's important to remember that even after the dot-com bust, the internet didn't go away. The foundational technology was still there. The companies that survived, like Amazon and Google, went on to become the giants they are today. The bubble bursting simply cleared out the excess, the hype, and the unsustainable business models. The same would likely be true for AI. Artificial intelligence is a genuinely transformative technology. It's not just hype. Its potential to revolutionize industries from healthcare to transportation is real. A crash would separate the genuinely innovative companies with solid business models from those that were just riding the wave of hype.